Okay, so who are we? We're Regan van Rooy. We're a boutique international tax and transfer pricing firm. And we have a focus across Africa. We have a fully fledged transfer pricing team, looking at all elements of transfer pricing, as well as your international tax and structuring issues. I'm Cabrini McCarrick, originally from Ireland, worked in South Africa and across the African market for many, many years. I found Europe a bit too boring, so stayed in touch always with Africa, and working in with Africa is a big passion of mine. And I will just introduce you to Boris Pelegrin, the Managing Director of BTG Management Services in Mauritius. And Boris, if you want to give yourself an introduction and chat a little bit about what your firm is up to there.
Perfect. Thanks, Cabrini, and welcome to all our listeners. So yeah, I'm one of the directors in Mauritius. I've been here for 13 years. Qualified as a lawyer and specialized in commercial tax and legal. And yeah, BTG, we trust and corporate services based in Mauritius, also in Geneva. So we also have asset management capacity in Jersey and wealth management in South Africa as well, part of our greater group. So yeah, just pleased to be here and yeah, chat about transfer pricing in Mauritius.
It's an exciting topic now, Boris. It's not so boring. It's interesting.
It is. It's going to be interesting, I think.
All right. Well, let's hope so. Let's hope so. It's always a mixed bag. But okay, let's look at some of the basics. We're trying not to get too technical in this, but to make it relatively practical for your business. But what is transfer pricing? Transfer pricing is based around the arm's length principle. So we'll all probably have heard of the arm's length principle, but what is that? It's an internationally accepted standard which states that where conditions are made or imposed between two enterprises in their commercial or financial relations, which differ from those which would be made between independent enterprises, then any profits which would, but for those conditions, have not so accrued, may be included in the profits of that enterprise and taxed accordingly. Simply put, any related party transactions within a group must comply with the arm's length principle. And essentially that means you must treat your related parties from a pricing perspective as if it was a third party. And you don't just have to say that, you actually have to go ahead and prove that and support that it is arm's length nature. And often people are quite vague about it and say, you know what, we do negotiate it. But the tax authorities look for us to go farther and look for us to evidence that. So that's just the basics. Then we're always trying to figure out who's a related party. And often this is an easy question within a group, who's related, but each jurisdiction has a different definition of a related party that needs to be considered. But we also need to consider the wider OECD standard. And this is because transfer pricing is a two-way street. So is a transaction related from a Mauritian perspective is step one, but perhaps it's related from the other side. So in any event, from the other side or the other jurisdiction, let's take South Africa, you might have to comply with transfer pricing principles because the definition of a connected party may be considered wider. So again, not too much on the detail because most of you will know what a related party is in Mauritius. But a company is related to another company where the other company is a holding company or subsidiary, where more than half of the issued shares of the company are held by that other company and companies related to that other company. More than half of the shares, so we're at that 50%, is held by members of the other company. The business of the companies have been so carried on that the separate business of each company or a substantial part of it is not readily identifiable. You can see that's a kind of an interesting standard. And there is another company to which both companies are related. We've also included here the OECD definition because typically across the majority of Africa and the majority of the globe, this is the type of principle that applies, and it's recently been extended into the South African definition. And essentially here we're looking at enterprises that participate directly or indirectly in the management, control, or capital of another. It's a very, very wide definition. It is one we need to get to terms with, but the general trend is if you think you're related, you're quite likely related. If you're using the same brand name or have shared management, have the concept of control, you really need to be thinking about transfer pricing. And at a minimum, if you think you're not covered by that, make sure you've got some sort of defense pattern in place. We even have certain jurisdictions where even if you are not classified as a related or an associated party through the law, they have what is called a deemed associate provision. And that's important for Mauritius because it means that if the entity or the related party or the not related party, as it may be, on the other side of that transaction resides in what is considered to be a low tax or favorable tax jurisdiction, even if they are not considered related, you still need to prove that the transactions are arm's length. Zimbabwe is an example of one of those countries. So, this is a key point, but it is often the case that you're related as opposed to not. Where you're not perfect, you can ignore transfer pricing for the most part. So big picture, what is transfer pricing? Why is the world talking about it? And why do we care from a Mauritian perspective? So there's been an increased globalization of business, and the complexity of multinational groups has essentially heightened the scrutiny of tax authorities around the world regarding intergroup transactions. This has made transfer pricing one of the most critical and controversial areas in tax. You will have heard globally all of the big players, Coke, Nike, Google, Facebook, Amazon, all of the big companies, as well as many of the small companies, have comprehensive and very high value transfer pricing litigation cases going on. This is because of all the work that the OECD and the Base Erosion Profit Shifting Project. Essentially, the countries came together and started to demand tax transparency and started to say, well, look, our tax rules globally are out of date. Transfer pricing has been there in the background, and indeed we've had legislation on it, but it has only been a conceptual part of doing business. And now the OECD and all the different countries, including non-OECD countries, have basically stepped up the plate. And as a result of this, new legislation has come into place in the majority of the world. In the majority of the countries across Africa, new transfer pricing legislation has come into place. In Mauritius, we're going to talk about the specific legislative criteria in Mauritius, which as yet is on the lower end of the scale. But as we will also discuss, that doesn't mean it's at the lower end of potential risk when it comes to transfer pricing. But transfer pricing is essentially a tug of war between two tax jurisdictions. Each one wants their fair share of the tax base. So that is why you can't just look at transfer pricing from one side of the equation. Take Mauritius. We can say we don't have annual documentation requirements in Mauritius when it comes to transfer pricing. So therefore, we don't need to worry about transfer pricing. But transfer pricing is a two-way street. So if you've got a transaction with South Africa or Kenya or the UK or Singapore, you need to look at the rules that are in place there and ensure that the transaction from a holistic perspective is compliant with the law. You can't just isolate it to one particular jurisdiction. The key focus of transfer pricing, as I said, is on prices between related parties in relation to typically cross-border transactions and whether or not these transactions are arm's length. I say typically cross-border because each jurisdiction is different, and there are quite a number of jurisdictions in Africa where domestic transfer pricing is included in their legislation. Simply put, or big picture, let's say, profits should follow value creation. And the complexity and the subjectivity with respect to transfer pricing is determining where and how that value is created in a group supply chain. so that you can attribute the appropriate profit or the appropriate taxable profits in accordance with that value creation. Proving that is essentially a complex and not a simple exercise, but it is essentially done through the transfer pricing documentation process, which we'll go into a little bit later on. So again, the onus is on the taxpayer to prove that the transactions are related. Really, we could say that the tax authority has a much easier job here because the onus is on the taxpayer. So we can't just wait until we're challenged and be kind of on the back foot. We need to be proactive in terms of we're compliant and discharging this burden. How do we do that? That's through our documentations, our associated legal agreements, and key components of our transfer pricing work, which we call the functional and economic analysis components. The main focus, or one of the main focuses when it comes to transfer pricing that is particularly relevant to Mauritius, is the focus on the economic substance of the transactions over legal form. And the underpinning fact pattern that's asking, does our conduct on the ground, our decision-making capacity, our significant people function match what our legal agreements say or match what our transfer pricing policies allude to? I say that's a huge issue for Mauritius because typically we have large and high value transactions flowing through Mauritius, but we may not have or may need to further develop true substance on the ground to be able to support the arrangements that we have in place. There is a focus, as I mentioned, on the value chain and key value driver analysis. All of this is in your transfer pricing documentation, or should be. This is your narrative to the tax authority. How do we do business? How do we engage with our related parties? Not just what's the price, but what are the terms and conditions and wider commercial factors that impact how we do business? And this narrative is key to substantiating your group transactions. So any tax authority, whether that's the Mauritian tax authorities, your European tax authorities, or whatever jurisdiction it may be in. So to kind of put this simply, transfer pricing asks in a group, who does what, where are they doing those activities or bearing those risks? What is the economic significance of those activities in the context of either the value chain of the transaction or the value chain of the wider or holistic business? How much do we get paid, or how much profit is earned with respect to those activities? And broadly speaking, across the globe and indeed across Africa, transfer pricing is governed by the OECD guidelines. The MRA, whilst they've not fully adopted the OECD approach, have indicated in our dealings with them certainly, and in various other matters that have arisen, that the OECD guidelines are a base, albeit, of course, there can be local deviations with respect to various items. Who cares about transfer pricing? I care about transfer pricing. I think hopefully the team cares about transfer pricing, but more importantly, the tax authorities and the global regulatory bodies really care about transfer pricing. There's a keen political interest around transfer pricing, particularly in Africa or developing jurisdictions where there is a perception, and I say perception because it's not always the reality at all, but there is a perception that profits are extracted inappropriately from those jurisdictions, which makes our job as businesses and tax advisors a bit more difficult. We need to explain our business model, and we need to ensure that what we're doing is appropriate, not just with the rules that were there 1 year ago or 2 years ago, but with international best practice. So the tax authorities obviously think there's money in it. Off the back of COVID, there's even more pressure on tax authorities to get revenue. So if you've got a multinational presence and it is perceived that there is profit or value somewhere in that that's not falling in the particular jurisdiction of the tax authority that's looking at your transfer pricing, you can expect challenges. Taxpayers, as I mentioned, if the tax authorities care, the public care, and your stakeholders care, of course, the tax team and the business team cares. It does go beyond the tax function because of the links to reputation and international best practices. So it goes beyond the tax to the C-suite of your business and the onus is on the business to understand what's transfer pricing. Do we have a high risk, a low risk, a medium risk? And what do we need to do to ensure that we're applying best practices, but still ensuring that our business model makes sense, or our transfer pricing model, let's say, and that we can still optimize our structures in the context of this ever evolving legislation. So whilst transfer pricing is about compliance and risk management, it is more than that, and we can also, if we're strategic, focused about it, look to optimize our business model opportunities through this process as well. So I always like to say it's not totally terrible. There is opportunities within the context of what we do, and the risks are high enough to justify the types of investment that's required for groups these days to get their transfer pricing right. In terms of wider global trends, what we have is these external forces. So I mentioned there has been new legislation in the last 5 years in about, I think it's about 18 African jurisdictions or so forth, where they've taken in annual compliance documentation requirements. We also have a huge upskilling of the tax authorities. That's with the help of the African Tax Administration Forum, the help of the OECD, and the help of various other more experienced in transfer pricing, at least, tax authorities who are working with the various African bodies to make sure that they have the skills to tackle transfer pricing. Then we have a whole layer of documentation requirements which have popped up globally. Country by country reporting is a requirement in Mauritius. Master file and local file is not a strict requirement in Mauritius annually. However, it most likely is on the counterparty jurisdiction, and it is more often than not likely that how you present your Mauritian operations in that documentation is absolutely critical to managing your risk. The other thing that we're seeing is TP disputes, and we're seeing reallocation of budgets, basically from a tax authority perspective and also internally to deal with the type of disputes and information requests that are being asked. When we talk about tax transparency, remember we're talking about also the information sharing between tax jurisdictions. So people signing up to the multinational information sharing agreements, and this is happening now, and we're seeing it happening in practice. Tax authorities are surprisingly quick in giving information. How all the tax authorities are fully going to tackle this absolute plethora of information they have on hand is really yet to be determined. But what we know is, with this level of access to the information, you need to make sure that the information you're presenting is the right narrative to a tax authority and is the right narrative in the context of your business. Of course, this has an impact internally. We can't just have all of these global shifts and changes and new legislation without increasing the compliance burden on you and your business. Having to upskill internally in terms of what's transfer pricing, how does it impact us? And I guess for a lot of people, the dream is that they could say, we're not a multinational business, we do not transact, so therefore transfer pricing is of little importance to us, which of course can be good news for many people. What we're seeing as a result of basically taking transfer pricing seriously is that we're seeing alignment of business and TP models. What we've seen in practice is that the transfer pricing model has not been integrated fully into businesses, has not been properly documented and has not been fully assessed in light of all the global changes. So there are changes happening. Businesses globally need to catch up. And this is typical when you have an expansion of the law and detailed clarity coming globally in terms of what concepts really mean, and a big focus on being, not shifting profits, being good taxpayers. The trendy thing these days is to go green and be a good taxpayer. It's not to be the best strategic tax planner. It's how to be good and focused, but still maintain really strong commercials and business results, of course. Documentation has gone from something that was on the shelf or not really an issue to becoming a compliance obligation in a lot of jurisdictions. And we also have seen a lot of reconciliation of data. So through this process, you have your financials, which will disclose something about your related party transactions. You then have your tax returns, which may have detailed TP questions. You have your actual transfer pricing documentation, you have your legal agreements, and you have your practice on the ground. All of these items need to start talking to each other. If we haven't looked at transfer pricing in a level of detail, often these items simply don't talk to each other. They may be dealt with by various different parties within the context of your business. But what's important is, if you're challenged on transfer pricing, this is how a tax authority does your audit. Show me your financials, show me your tax return, show me your transfer pricing documentation, show me your legal agreements, show me your numbers. Now let me interview your people on the ground to say that all the stuff that you're talking about is actually what your business is telling me too. So this is why it's not just a tax issue. The business needs to understand the transfer pricing model, not in detail, not as much TP tech nerd stuff as we might deal with, but it needs to understand conceptually. It's just too big with respect to international businesses to ignore and leave it as a sole issue for tax people. Of course, we've got to implement and monitor, and often businesses, and again, it depends on the complexity of your transactions, but you have to have some level of internal process and procedure in place to be able to make sure that what you say you're doing, you're actually doing on the ground. And if there's a new transaction, who should it be flagged to? Should it be your head of tax? Who should it be? You have to have some kind of process in place to deal with transfer pricing, similarly that you would to any other internal audit process, for example, that you might be dealing with. Okay, so now we're going to go to the overview of the Mauritian transfer pricing legislation. I'm going to hand it over to Boris, who will take over from this point. Boris, over to you.
Excellent, Cabrini. Everyone can hear me, I hope. So there's no glitch, but thumbs up if that's good. So thanks, Cabrini. Yeah, so I'm going to dive in. I mean, having spent 13 years in Mauritius, come across the Income Tax Act, obviously, and had to deal with a lot of client issues on the Income Tax Act as well. So it's very interesting. What Mauritius is a financial center. Let's put it, it's not a tax haven, it's a financial center. So you'd find it a bit weird. Why would you have transfer pricing in a financial center? It's just, it's contrary to what your normal thinking goes, because the normal thinking is, let's pool all our profits in a financial center because the tax rates are low. And let's optimize the deductions in those other high tax jurisdictions because the tax rates are high. So why would the MRA go and do this to us and create this havoc of transfer pricing in Mauritius? But there's various reasons. It can be pressure from the OECD, Global Tax Forum, and things like that. We've had our rounds on being on a blacklist and then a happy grey list. So Santa's naughty tax list, we don't want to be on that again. So hence, I think that's what that's what the MRA is gunning for. It might be weird, but it's a fact we'll have to deal with. The other thing, if we do reach section 75, so that's we'll call it the transfer pricing section, or the arm's length a test section. It's sitting there in the middle of the Tax Act in Part 5 of the Tax Act in the international tax section. So it's sitting a bit lonely. It's got no friends. It's got no schedule. It's got no regulation with it. So, you know, I've come from, I originally started my career in South Africa, so I understood transfer pricing. We read that act and you read your practice notes and all the other things that was quite juicy sections in the South African Income Tax Act. But here we've just got poor old section 75, 1 and 2. In a nutshell, so let's just get started with how this section would work. So, well, let's ask the first question: how would the MRA know you're dealing with a related party and you might be transfer pricing? Well, it's fairly simple. We have a corporate tax return everyone has to file. Now, we're assuming most of my clients, and I think most of the listeners, will be familiar with what is the Global Business License Company. So that's a special tax and legal regime company in Mauritius, used mostly by foreign corporates or foreign individuals to do business from Mauritius and not in Mauritius. So they'd set up companies here that would then either be holding companies, procurement, construction, IT, IPR, all those sorts of things. And that company typically will have related party transactions with its home country company or party. So now every global business license company has to file a corporate tax return. And in the corporate tax return, they've got two little questions, and it starts right at the beginning. If everyone's looked at the Mauritian tax return, they said, I think it's question 7, did the corporation have any transaction with related companies and or individuals during the income tax year? So if you tick that, you're forced to answer the next question. If above is yes, were all these transactions based on an arm's length price? And of course, you're going to say yes. And that's where the onus of proof now comes, because you just said yes, it is arm's length. Anyway, section 75, in a nutshell, looks at 3 conditions. It says, look, is there a non-resident that has a business or does business in Mauritius or has an activity, an income-generating activity in Mauritius? And if so, does it have a related party it's doing this transaction, business, or income-generating activity with? And if so, well, then we have to, the Director General has an ability to test an arm's length. Is this transaction, commercial, financial transaction, at arm's length? The third condition is, if it appears to the Director General of the MRA that there's no net income, so the company is not generating any net income, this business in Mauritius is a related party, or the net income is less than would be expected in this particular sector or industry, then he can make a determination and recharacterize that net income based on what he thinks is an arm's length price. So it gives him the ammunition. And it uses the terms, you know, appears to the Director General, or the Director General is of the opinion. So they'll exercise their good judgment and they'll make then an assessment. Now, we did say, look, there's no other schedules or there's no other things that can assist us with the review. But I do believe, I think as Cabrini said, the MRA will go and look at the OECD guidelines when they try and interpret section 75. There are some other sections in the Income Tax Act, more in the anti-avoidance part 7 there, more in the anti-avoidance provisions or sections of the Income Tax Act, sections 84 to 90. These kind of double up maybe with section 75. It's a bit unclear on how the MRA would they use both at the same time or one in exclusion of the other. But these sections, and I'm going to go into each and every one of them, but they generally look, if you've got excessive management fees, if you've got excessive remuneration, if you're extracting profits excessively out of a company with a related person, that's when the first time they use that term related person, then they can, the Director General can reassess that and reevaluate that and add back the income or disallow a deduction, so which normally happens. But these are particularly what we call anti-avoidance provisions, not the transfer pricing ones. They normally should all fit together, but they kind of sit a little bit differently in the Income Tax Act. So so that's then if we moved on, I'm not going to touch on everyone there. Country by country reporting, I'm going to hand over to you, Cabrini, just to give us a bit of an understanding of what is it, so our listeners can understand.
Okay, and just to add to what Boris was saying, and when we come to basically the specific Mauritian trend risks, we're going to see that, yes, MRA can challenge outbound payments that we make to other jurisdictions if we're paying excessive management fees, if we're paying excessive anything. But more often than not, the risk in Mauritius comes from the other side. So, for example, if you have contract revenue derived in Mauritius, but your significant people are sitting in a location that's not Mauritius, the risk from a Mauritian perspective is that the profit that you're actually incurring in Mauritius could actually be recharacterized as to be due in another jurisdiction. So we'll talk a bit more about that. Lower value you need to look at it from both sides. But what we see practically in Mauritius is the substance and significant people function issue as a core risk. So even though it mightn't be specifically a Mauritian risk, it becomes a Mauritian risk if it's putting your profits in Mauritius under question. But okay, country by country. So this is the one that Mauritius have gone, yes, we agree, we're going to take it in place. What is country by country? Country by country basically will not impact a large number of Mauritian businesses. It impacts large groups who have in excess of 750 million euro in consolidated turnover group wide. And in that case, Mauritius has often been chosen as if it is the holding company, it has to submit this group information to the MRA. It's very annoying, but what it is basically information about the whole group. This is the activities of what we do. These are a number of people, stuff like this. Basically, the tax authorities, including MRA, run an analytics on this. And the type of thing they're looking at, for example, is the level of profit per individual or per role. So it's a big flag if 98% of my profit sits in Mauritius and I've one person there and I've 10,000 people in South Africa. Simple things like that. So the information is group wide. A number of my clients meet this threshold. There isn't many, but it's basically showing you where the MRA are going. They've taken in step one of the documentation requirements. It's highly expected that step two in terms of local file and master file are going to come, just knocking on our door. Of course, there's penalties and all sorts of things for not doing that later. But if anyone is meeting that threshold, rather contact me and I can talk through that. It is a group consolidated threshold, and it is the obligation typically of the parent of the group or the surrogate. Other areas in terms of thin capitalization, there's not specific thin cap rules, but we have to apply with the arm's length principle. We're going to talk through an example on loans, so I'll leave that section for our chat later, Boris. There's also this concept of advanced pricing agreements. What is that? This is this global tool that we have, which is where two or more tax jurisdictions agree to the pricing of certain transactions. So this is essentially a mechanism to create tax certainty for multinational groups. It is typically only relevant for high value or complicated transactions. They mightn't have to be complicated, but at least high value, because it's obviously a substantial amount of investment. We've got APAs only in a splatter of African countries. It seems that the African tax authorities are not mad keen to be in a negotiating position with maybe what they might see as tax authorities who are more experienced in transfer pricing. So there's a focus on building up capacity. South Africa has announced and issued its draft legislation on APAs. Mauritius will have to wait and see. But in Mauritius's wider goal of being an attractive place for multinational businesses, it's likely that the APAs is going to be a beneficial tool for Mauritian businesses and makes practical sense, because tax certainty is what multinational groups are really trying to seek out. Nobody wants a constant headache about how they do business. They kind of want to be able to at least know what kind of tax they have to pay.
Yeah.
So
Cabrini, if I can also add, I know that there is a ruling section in the Income Tax Act as well. It's unclear on whether you could go to say, let me get a ruling. I know it's not an advanced an APA, but they could if taxpayer is a bit worried, look at a ruling, but then it has to be based on an actual transaction that's about to happen. So that could also be a consideration. But yeah, you're quite right. We'd love to have better legislation around advanced pricing practices and authorizations.
These things are a matter of time, because what's happened is globally, we have moved extremely quickly on transfer pricing. I can name 20 countries that have updated their legislation in the last year or 2 years. Ireland, Portugal, Zimbabwe, all across Africa. It's constantly going. And of course, we have Pillar 1 and Pillar 2, which we didn't have time to cover today. But big picture, Pillar 1 and Pillar 2 are all transfer pricing concepts, right? They're all about how we share profit within the group and what tax you pay. So it's too big a topic to cover now, but bear in mind that the changes that are pending globally, which slowly and sometimes quickly we adopt in Africa, are all relating to these key concepts around transfer pricing and what's a fair share of profit per jurisdiction and what's required to substantiate that. Okay, we're going to quickly touch on, so whilst we know Mauritius, you don't have to prepare annual documentation, but you do have to prove that what you're doing is arm's length if you're challenged. So OECD best practices, which of course will filter into what you should have and should be doing in Mauritius, is a local file, a transfer pricing local file that covers your related party transaction. That is not just a kind of a 2-pager, unfortunately, and depending on the value and the complexity of the transaction, more or less information might be the right approach. But there are 2 main components, big, juicy components that go into your local transfer pricing. That's what we call functional asset and risk analysis, which looks at the functions, assets, and risks that each party to the transactions partakes to substantiate the second part, which is your economic analysis or your benchmarking studies to support the actual prices charged. So the format that this analysis takes is OECD compliant. It's the same in South Africa, Zim, Malawi, Mozambique, Ghana. Even in the UK, the UK have just announced new local files requirements. So everybody's getting on board to basically saying the only way we can do this is to have one set of rules, broadly speaking. There is different things locally, but big picture, I would say that the key concepts are similar. So in there is your benchmarking studies as well. And that's basically your proof. Often it's done on an independent database. So we say, I'm charging a 3% royalty for my brand. Okay, is that 3% arm's length? I'm going to go to a database. I'm going to look at a whole load of independent data. I'm going to do a comparability analysis, compare what I'm doing with my related party to this third party. And I'm going to come up with a result so that I could say to any tax authority, here you go, I've tested what I do against this independent data, and my result falls within an arm's length range. We generally don't need an exact correct answer, but at a minimum, we need things to fall within a range to be able to support it without having the functional and the economic activity. You will not be able really to discharge your burden of proof to a tax authority. So that's what a local file is, and that's what's there. The master file, again, for example, in South Africa, you have to submit this to the tax authority. Mauritius doesn't have a requirement, yes, although we have seen the MRA request the group master file. The master file is a group-wide document. The local file is an entity-specific document. The master file looks at how you operate as a whole group, with particular focus on your intangibles and your financial activities. And what this is basically a snapshot of how you do business. Why does the tax authority care? Because if you transact in Africa or in one jurisdiction in one way, which means they might earn less profit there, and you transact in Europe in another way, which might mean they earn more profit there, the African tax authorities are going to knock on your door and say, well, the same thing is happening here, and we're paying more for this, or we're getting our tax base eroded. So strictly speaking, you're supposed to have consistent transfer pricing policies, and any variations or differences need to be explained. Otherwise, very easy for a tax authority to challenge that type of arrangement. And your master file has to summarize everything. And of course, this master file can then be shared amongst various different tax authorities. So absolutely tons of information is now available, or will be available certainly in the short to coming years, to all the tax authorities. So you need to be happy with the narrative that's in your documentation. Now, this is a little bit technical in the context of what we're doing, but just to make it clear that there are certain methods that OECD are accepted to support your transfer pricing arrangements. And one of these methods needs to be used in your transfer pricing documentation. It is not sufficient to say, well, you know, we've looked at turn externally and we think it's fine, and based on industry and commercial, we think it's fine. You need to use one of the methods. The three most common methods perhaps, is the CUP, the comparable uncontrolled price. And this is where you directly compare the price of a related party transaction to a third party transaction. Not just the price, but the terms and conditions of those arrangements. It follows a specific OECD format and goes through various economic type analysis to prove. And then one you might be more familiar with is the transactional net margin method. This is essentially where we characterize our tested party, we compare this, we set up the criteria on a database for the same type of maybe it's a distributor of IT products. So you're going to look for independent data and compare the various levels of profitability of these independent data against your whole or segmented results locally. You will have seen that that's what we call benchmarking studies. You also have a more complicated but much more common model, which is coming about now, called the profit split model. And this is essentially where each entity to the transaction get a routine return for their routine activities. And when the nature of their operation is so integrated that it creates additional intangibles that bring about additional revenue, what we call residual profit above routine, a profit split will look how to share the residual profit in the value chain through a contribution analysis. Again, if you're not a TP geek, this might seem a bit technical, but the point of it is the analysis you need to do to support your transfer pricing follows a specific path and methodology, and you need to get those building blocks right. And then just big picture again, when we think about what's the transfer pricing life cycle. First, you have a policy. What's your TP policy? You design it, you check what you're up to, you know what you're doing. You then have to document it and benchmark it. The piece you want to avoid, of course, is dealing with your tax authorities on any dispute or controversy issues. And all across this, we need to remember, it's not just a paper exercise. We need to implement and monitor and operationalize our TP into our business. Again, this can mean a lot for some businesses and a little for others. if you simply pay one service charge from your company, you do need a functional and an economic analysis that you might be able to leverage from group, for example. So you need more basic things. If you've got a more complicated business, you're buying and selling goods, there's IP there, there's contract revenue accruing in one jurisdiction and contract generating activities accruing in another jurisdiction. Transfer pricing is more complex for those type of businesses. TP issues trending in Mauritius. And Boris, I'm going to go through it, and then we're going to go through your example and get a bit more practical. I'm conscious I'm rushing through this a little, but I want to touch on the key trends. The biggest high value risk in Mauritius businesses is this focus on substance and significant people functions. And the question of, are the profits that are earned in Mauritius justifiable in relation to the functions, assets, risks, and decision-making that's occurring in Mauritius? This is the same with all jurisdictions, but typically in Africa or in the world, we will have flows through Mauritius, which is a lower tax jurisdiction, which, you know, may need to be looked at, because we need to ensure that we have economic and not just legal substance to be able to support our business operations there. So this is the risk of double tax. If the other jurisdictions makes an adjustment and it says we should earn the revenue with respect to this activity in South Africa as opposed to in Mauritius, there's going to be an adjustment. So this adjustment needs to be looked at from both sides of the jurisdictions. Interest-free loans, obviously, there's a fantastic commercial and business reason why people set up in Mauritius. We need to explain this, by the way, in our TP documents. But we've got, you know, the ability to access capital. We've got the many advantages of doing business in Mauritius that are totally not related to tax. This is an important and critical part of our analysis. But one thing that's very common is interest-free loans. Now, interest-free loans generally poses a problem for the lender, right? Because the lender is entitled, in theory, to an arm's length interest on those loans. So Mauritius have started to care about that. You know, okay, we want an arm's length interest here. So even though we're an attractive jurisdiction, we want to attract investment. We're starting to apply transfer pricing principles, so we want our interest. In the event that it's not being challenged from a Mauritian perspective, you need to consider from the borrower's perspective. Two items. One, is the quantum of the loan arm's length? Would a third party actually lend me this? Because to be arm's length, you have to look at both the quantum and the interest. And then the big issue that we're seeing in Africa now is deemed interest withholding provisions. So normally we used to say, it's okay, we don't pay any interest, so, you know, we're not too worried about it from an African perspective. However, tax authorities are getting clever about this and saying we're going to deem that interest is charged because, of course, they want their withholding tax. So you can get, and withholding tax is obviously a huge problem in Africa, and we're always trying to find the right balance. But tax authorities will look in isolation at your transactions. And they will look at your transfer pricing and make an adjustment to what they consider is correct. So groups have used in the past, well, I don't want to recharge those payments because I don't want to suffer the withholding tax. Then you've got a problem with, you can't deduct those costs in the jurisdiction where the activities are performed because they're not related to the revenue generating activity locally. And you've also got the issue of other people deeming that they have occurred because they're looking for the withholding tax. So we'd all love to wave goodbye to withholding tax, but we do have to deal with these type of complexities. The other big issues, substance, significant people function, and of course, effective management. So when they're all interrelated in terms of, how we structure our businesses, and the financial transactions and loans, simply because it's totally common. The other big one is around IP and intangibles, which globally is a massive focus. We cannot just legally sit our IP or trademark or trade name in one jurisdiction and charge it out to other jurisdictions. We need to look at what's called DEMFI. Who does the development, the enhancement, the maintenance, protection, and exploitation with respect to these intangibles? Legal, postbox, all of that is really a thing of the past. It is constantly being challenged globally. The MRA, and more importantly, the tax authorities on the other side of the Mauritian transaction, are becoming increasingly aware of these issues. And we really can't ignore this. We need to document our position, understand if we have risks or not, and move forward and improve our model where it needs to be improved, or go to sleep well at night knowing that we're comfortable in the position that we're taking and that we understand the risks of how we're doing business, because there's no such thing as a risk-free business. Okay, Boris, I'm going to hand this over to you in terms of the example, if you want to chat through.
Excellent, thanks, Cabrini. So, Cabrini, I'm going to ask you some questions. I'm just going through the first slide, and just for our listeners. So this is, let's say, a typical structure you would find in Mauritius, a Mauritian holding company owned by usually a trust. In this case, it could be another holdco or somewhere else, but I've used a trust. That trust is in Switzerland. So going from top to down, I've got a trust in Switzerland. I'm not paying tax on the trust fund because of the quirks in the Swiss law. It's not a taxable person. It's almost like a look-through person. So the functions as the trustee, the corporate trustee is based in Switzerland, and he's going to do some asset management, asset protection, and his assets are the investments, and he's got some investment and market risk, and personnel that he has, his directors, maybe some trust officers as well. The trust will own 100% of our global business license company, which obviously we all know pays tax at 15% or 3% effectively on certain specified income. And in Mauritius, I have my directors, my 2 Mauritian directors. It's a holding company, and its purpose is just to manage its investments in its subsidiaries, and it's got an investment in market risk. It's got no other employees, mind you, in Mauritius. Then going further down to all those subsidiaries on the left, I started with a Swiss company, pays tax in Switzerland, albeit at 14% after the cantonal and federal tax rates taken into account. And my directors are all sitting in Switzerland, and those directors provide some group strategic management to the group. And they've got the only asset there, there's a bank account and cash in it, and they've got some contractual risk on that service to the rest of the group. And the personnel, we just have some directors there. In South Africa, I have a manufacturing company. That's where I'm all going to manufacture my goods, and I'm going to sell them around the world. It's got assets of plant and machinery, some equipment and stock, and the risks of stock not selling there, I said. And we've got some personnel. We've got more juicy personnel down there, directors and employees. And on the very far right, we've got the good old British Virgin Islands company, not paying tax anywhere, but my directors happen to be sitting in Mauritius this time on the board there. And its functions, it owns IPR, intellectual property rights. And its assets are those rights, and its risk is any infringement of those rights, and the personnel, they are only the directors. So I'm going to look at 4 transactions, if I can ask you the question. So looking back to the top with the Swiss trustee. Now, the Swiss trustee is going to inject a loan into my Mauritian company, and is going to charge a juicy interest rate of 15%. If I'm the MRA, I mean, and looking at that, what do you think, Cabrini? Do you think there could be a challenge based on a loan like that with an interest rate?
So let's talk about loans. So basically, from a transfer pricing perspective, and Switzerland also has transfer pricing rules. Again, they're pretty low key, but from a transfer pricing perspective, when it comes to the loan, you have to look at 2 elements. One is the quantum of the loan, arm's length, right? And 2 is the interest rate, arm's length. So from a Swiss perspective, they want to make sure that that there's a commercial purpose for this loan. That if they're using the fund for this purposes, that it makes sense for them, and that they're earning enough interest. From a Mauritian perspective, on the other hand, the MRA care that they're not overpaying in interest, because that's a deductible expense. So essentially, when it comes to high value loans, and there's been, the OECD have released a whole paper in January, I think it was, on financial transactions, because they have not been properly handled before. It is a complicated area. But essentially what all the rules are telling us is you need to do a credit rating analysis, typically of the borrower. Right? How do you know how much money they should get? Like what a bank would do. You have to look at their credit rating, determine what that is, and figure out the quantum that they could do. The quantum of what they can lend totally depends on their own financial and commercial position. What could you lend from the bank? So you have to prove, and there was a massive GE case where there was basically artificial funding going through various jurisdictions, but it was structured in such a way only to get a tax benefit and didn't have the underlying substance and other requirements there. And that set a precedent globally for, you need to take your loans seriously. You need to look at the quantum. You need to do what's called a credit rating analysis and what we call a debt carrying capacity analysis, which is basically compare your financial data, terms and conditions, again, to that of third-party data, which is contained in the various databases that we have, and prove it. There's no simple answer when it comes to loan, but exactly. The MRA are challenging non-charging of interest as a key priority because it's more common. But if they're seeing high interest rates again, of course, if I'm tasked in the MRA to deal with transfer pricing, I'm not going to ignore this stuff, right? That's my job now.
Exactly. I mean, that also ties into number 3, like you said. Yep. We don't only look at Mauritius, now look at South Africa, and we've just sent that interest-free loan down. Yep. And obviously the SARS, South African Revenue Services, is looking at it as well and saying, hang on, I'm losing out on a bit of withholding tax. I mean, had you charged interest, we would have withheld some tax on you. So that would also create, almost this dual thing. Look at it on both sides. Don't just focus on the one side. But point taken, MRA might be saying, look, I'm losing out on income here. And if I'm an MRA and I'm sitting on the 4th year of the corporate tax return being filed and I've got 0 net income because I'm extracting all this interest that way and I've got no interest coming in, you're quite right. I might say we need some revenue. Mauritius post-COVID and all that, every country is trying to generate revenue. So it's not like GBL, no, they won't touch us. I think you've got to focus a little bit more on that. So then number 2, quite interesting. So I've got my Swiss team in Swiss company. They're running some finance and treasury. They're doing some strategic management for the rest of the group. And they're going to advise the Mauritian company. They're going to charge a management fee to recover, let's say, those crack team of directors sitting in Switzerland, all their salary. Now, obviously, that's going to create a deduction. We've got that interplay between the tax avoidance provision, excessive management fees. We've got the interplay of Section 75 saying, is this arm's length? What do you think the MRA would do when looking at that?
So management fees and service fees are common. However, what you need to do is make sure that you can support the fee. There's a number of things you need to do. Is one, you have to look at the cost base and make sure that the costs that are being recharged are appropriate. So the costs match the services provided. Make sure that you're not paying for duplicative services. So imagine in this group, there's 40 different entities as opposed to just one. If it's one and they're paying a management fee, it's hard to get it wrong. But if you're within a group, how do you share out this central pot of costs? And that's what the tax authorities care about, that the appropriate allocation of those costs are being shared out. They're not just stuffing other costs in there. The appropriate cost is a cost that you can evidence provides you a benefit locally. So you can't just say we did this marketing campaign, but basically it was in Europe, and then expect Mauritius to pay for it. This type of logical things. And there's been a lot of challenges on management fees generally in Africa in terms of being excessive or not supportable. So you need to actually document it and make sure that the allocation keys and the cost base that being utilized are correct. So long as you can do that, it is very common to recharge management fees with an arm's length markup. It's not
Perfect.
just a cost, you have to add that markup in there somewhere.
Excellent. And it's always key, the documentation. Let's get that documented and it's clear when the MRA asks. And then the last one, so the BVI company, it has intellectual property rights. And then I'm aware, look, there's various methods on how to charge a royalty fee for intellectual property rights. But here we went directly to net income and said, well, you know, the GBL's net income at 10% of net income, that's what we're going to charge you for using a trademark in our domain names for the group. And that's obviously going to create a deduction, hopefully on the Mauritius side, and income in the BVI company side. So we're trying to get from tax paying to low tax to no tax paying position here. What do you think there are the challenges if the MRA approaches us on that?
So the very first thing you have to do is identify what the intangible is and what value the intangible has. So, you know, we say trademark, trade names, what is it? So you define it. And then you have to determine not who legally owns that, but who's developed it, who's enhanced it, who's paid the cost, what's the maintenance is, right? So determine that economic ownership of that intangibles resides also with the legal owner. It is common that the legal and the economic ownership is shared between different jurisdictions. So IP, just because you register something someplace, does not mean that the value of the intellectual property resides in that jurisdiction. One of the biggest things that's high value items that's being challenged in transfer pricing is people thinking their IP sits in one jurisdiction, but from a transfer pricing perspective, it actually doesn't. So you can only get a return, the return goes to the value creator. So assuming, right, that it is the BVI that's created all that value and that those activities relating to the intangible are not dispersed between the group, you then have to benchmark. 10%, for example, for the use of trademarks, I've never seen one that high ever. Normally it's specific. If I'm a high value brand, what it is, if I'm this, whatever, what's the intangible, you have to benchmark that rate. And then you have to substantiate it through, you know, various documentation to say that that's correct. We have to use it. We have to get value of it. We have to not, you know, if I'm Coke, right, you can see I'm internationally known. And if I sell under Coke, I'm going to sell more products. But if I am a European brand and I've just moved to Africa, how valuable is that brand? Should I be paying the same amount, or am I generating intellectual property locally? So what I'd say is all things IP are very complicated. And if you're dealing with high value IP, you have to do comprehensive analysis. And I would say this is clearly evident by the fact that there's a whole chapter in the master file on what is the group intangible strategy. And more often than not, intangibles is an area that business generally struggles to understand, unless it's totally obvious, because it's not just brand, it's operational know-how, it's manufacturing know-how. You know, it's where's your marketing team sit? What's your marketing? You know, it's so wide what can create an intangible. There's intellectual property and there's a softer layer. So often the big struggle is properly identifying what that is in the first instance. Some groups don't charge at all, and that could be a risk.
Exactly. Okay, perfect. I think key there, the key takeaway there was obviously illegal and economic ownership can be different. It's not just as simple as just registering IP in a jurisdiction and say that's it. We can trap our profits there. Good. Thanks.
Exactly. We're slightly over, Boris, so I'm going to wrap up quickly. Thanks to everyone who stayed on the extra few minutes. Well, I think the key takeaways are, while Mauritius is lagging behind in terms of documentation, They still have the powers under law to make transfer pricing adjustment. We definitely have transfer pricing risks in respect to Mauritius, even though it's the other side of that equation that we need to be thinking about. If you operate in a group, you cannot ignore that. You cannot just say, okay, I don't have to give a document to the MRA yet, because your risk is substantial and it needs to be considered from a centralized business perspective. That said, Mauritius is on the move. The MRA are definitely upskilling themselves and have started to challenging. We've got a number of live issues where they will start with information requests. They are asking for documentation. Of course, you can say, I don't have any documentation, but then how do you discharge your burden of proof? You're already starting behind. So in terms of next steps, what should we do? It's key to start to understand what you have in place. Do you have documentation? Do you have a legal agreement? Does group have something? What do you have in place in terms of documentation, policies and procedures when it comes to TP? And do a health check. You can do this internally. Sense check what you have and try to identify the gaps and pitfalls. Of course, we're more than happy to assist with that. And then you need to design a strategy and have a TP strategy to ensure that you've got a robust TP framework in place. This might be upgrading your legal agreements, doing your documentation, explaining to business various different issues. Whatever it might be, it's totally unique to your business. There's not kind of a one solution fix everything, I'm afraid. You then have to implement and monitor transfer pricing in your business. For some businesses, again, this is absolutely critical. For others, it's a much simpler approach. And unfortunately, transfer pricing, it's not just going to disappear. It is the cornerstone of international tax currently. It has a significant impact on where we pay profits and how we pay tax as an international group. How can we help? Regan van Rooy can help in terms of we offer all the things on transfer pricing, from documentation to benchmarking to health checks to the whole shebang, and of course controversy management, which you'll all want to stay far away from. In terms of Boris, I will go to if you have a comment there to wrap up, and I'll just say I think Stephen, one of our team, was addressing questions and answers as we went along. Because we're over time, we're going to deal with those questions and answers also via email. Please email us to ask us any questions. We'd be more than happy to assist. So Boris, I leave the last words to you, except to say thank you to Boris and everybody so much for joining us today. Boris.
Excellent. Thank you, Cabrini, and thanks to your team as well for organizing that. And really interesting stuff. And I think as part of our drive as well in BTG Mauritius is always making sure our clients, their risk management is in place, be it from compliance, be it from tax. And when we sit at those board meetings and trustee meetings, that we address these usually in our meetings to say, okay, let's have a look, let's have a health check. And where we do find things like that, happy to talk to Regan van Rooy as well to help us with the documentation and any tax controversy. So thank you very much to all our listeners and Cabrini as well.
We will share the recording, everybody. We will share the slides, and we look forward to further engagement. Thanks so much, Boris, and thank you so much, everyone, for joining us. Thank you.
Thank you. Bye-bye.
Bye-bye.